Indian rupee recently crossed the 95 rupee mark against the dollar. But did you also see it as just another news headline? What if I told you that this is quietly making you poorer? Your bank balance may look exactly the same today, but globally, your money is buying less. Even if you never plan to travel abroad or send your kids to a foreign university, a falling rupee still affects your everyday life. The phone in your pocket, the fuel in your car, and even ingredients used in many medicines are all connected to global prices that are driven by the dollar. So when the rupee weakens, importing these things becomes more expensive. And slowly, that higher cost starts showing up everywhere around you, which results in rising expenses and lower purchasing power. In many ways, a falling rupee acts like an invisible tax on your future wealth. So when the rupee weakens, the most common advice you'll hear is just buy IT or global stocks. And while that sounds logical on the surface, the reality is far more nuanced. And it doesn't really solve your portfolio problems that easily. So in this video, we are going beyond the usual headlines. We'll understand these points one by one. Why does the rupee keep depreciating? How does it affect your personal finances? Why even debt funds may not be as safe as they appear? And most importantly, how should you structure your mutual fund portfolio when the currency itself is under pressure? So first, let's discuss why does the rupee keep depreciating? Have you ever wondered why the rupee keeps falling against the dollar despite India becoming one of the fastest growing economies in the world? One of the biggest long-term reasons behind this is the inflation gap between India and the United States. If prices rise faster in India, the rupee gradually loses purchasing power relative to the dollar over time. Also, since India is a net importer, the country constantly needs US dollars to pay for imports like crude oil, electronics, machinery, fertilizers, and gold. This steady demand for dollars puts pressure on the rupee over the long term. Back in 1991, $1 was worth around 17 rupees. Today, it is close to 95 rupees, which means the rupee has weakened by roughly 4 to 5% every year on average over the last 3 decades. But in 2026, multiple global forces are hitting India at the same time. In fact, the pressure has been so intense that the rupee posted its biggest annual decline in 14 years, falling nearly 9.5% in FY26. The first reason is oil shock. India still imports nearly 90% of its crude oil requirements. So when global crude prices rise, like we recently saw with Brent crude remaining consistently over $100 per barrel, India needs a lot more dollars to pay for that oil. Higher dollar demand automatically puts pressure on the rupee. The second reason is FPI outflows. In just the first 4 months of 2026, FPIs pulled out nearly 2 lakh crore rupees from Indian markets. And every time foreign investors exit India, they sell rupees and buy dollars to take that money back home. That again puts pressure on the currency. So the concern recently is not just that the rupee is falling, it's the speed at which the fall has happened in a very short period of time. Now, this may sound like a purely macroeconomic issue, but the impact eventually reaches your everyday life. Which brings us to the next question. How can it affect your personal finances? Think of it like a household that keeps spending more than it earns. Over time, the imbalance starts putting pressure on its finances. At a national level, that pressure begins to reflect in the value of the currency as well. Because when the rupee weakens, imports become more expensive and companies eventually start passing these costs to consumers. That's why many FMCG companies have already increased prices by around 3 to 4%. Smartphone prices have risen by roughly 1,500 rupees on average, and even international subscriptions like OTT platforms, AI tools, or cloud services quietly become more expensive. And this eventually pushes inflation higher across the economy. And if inflation remains high, the RBI may increase interest rates to control it. Higher interest rates make home loans, car loans, and business borrowing more expensive, which can reduce spending and slow overall demand in the economy. Over time, this can put pressure on profits of companies and weigh on equity markets. And not just equities, even fixed income options like debt funds can also take a hit. Let's understand how. Are your debt funds really as safe as they appear in this environment? As discussed earlier, a sharp fall in the rupee makes imports expensive, leading to imported inflation. And when inflation stays high, the RBI may raise interest rates to bring rising prices under control. And this is where debt funds get affected. When interest rates rise, newly issued bonds start offering higher yields. As a result, older bonds that were issued at lower interest rates become less attractive in the market. To compensate for their lower returns, their prices or NAVs fall. And since debt mutual funds invest heavily in these existing bonds, the value of their portfolios can decline as well. This is why even the safe part of your portfolio is not completely immune during a falling rupee environment. In the short term, some debt funds can see returns fall sharply or even turn negative, especially those holding long duration bonds that are highly sensitive to interest rate movements. In other words, when the currency weakens, inflation rises, rates move up, and bond prices come down. Your relatively safer instruments can also take a short-term hit. Which brings us to the most important question for investors. What should you actually do? How should you structure your mutual fund portfolio? Now, when the rupee weakens, different parts of the markets react very differently. Some sectors actually benefit from it, while other sectors come under even more pressure. Traditionally, the biggest beneficiary of a weak rupee has always been the IT sector. And the logic is simple. Most Indian IT companies earn revenues in dollars but spend largely in rupees. So when the dollar strengthens, their earnings get a currency boost. But in 2026, the situation is far more complicated because the IT sector is now dealing with a much bigger challenge: AI disruption. A lot of the repetitive work that earlier required thousands of engineers is increasingly getting automated through AI platforms and tools. So even though a weak rupee helps from a currency perspective, investors are worried about slowing growth, pricing pressure, and lower demand from the US and Europe. And that's why, despite the currency tailwind, the Nifty IT index has still corrected sharply over the last 1 year, making IT one of the worst performing sectors in the market despite a weakening rupee. Pharma, on the other hand, has held up much better than IT. Unlike technology spending, demand for medicines is relatively stable globally. People may postpone buying a new phone or software upgrade, but healthcare demand usually remains far more resilient. As you can see here, Nifty Pharma Index has significantly outperformed not just the broader market, but other defensive sectors like IT and FMCG based on year-to-date returns till April 2026. And since many Indian pharma companies export globally, they also benefit from dollar revenues when the rupee weakens. That combination has made pharma one of the relatively stronger sectors in this environment. But while sectors like pharma or IT may benefit during certain phases, it's important not to over-allocate to these themes because sectoral bets can be highly cyclical. Entry and exit timing plays a very important role in sectoral investing. So ideally, such exposure should form a small part of your satellite portfolio, around 5 to 10% allocation. A more prudent and reliable hedge against rupee's fall is gold. Gold is priced globally in dollars. So when the rupee weakens, their prices in India naturally move up even if international gold prices stay flat. This is why gold ETFs or mutual funds can be a good hedge during currency weakness and uncertain global conditions. Now comes the next hedge: exposure to US stocks. Since investments in US stocks are denominated in dollars, Indian investors can naturally benefit when the rupee depreciates against the US dollar. Besides, India represents only around 4% of the global stock market. So if 100% of your portfolio is invested only in India, you are effectively ignoring the remaining 96% of global opportunities. And that includes sectors like semiconductors, AI infrastructure, advanced chip manufacturing, and global big tech companies. These are areas that still have very limited representation in Indian markets. So, by investing in them, you hedge against rupee's fall, plus get to diversify your investments. Traditionally, the easiest route to invest in these companies are international mutual funds. But that option has become increasingly restricted because many fund houses are approaching RBI overseas investment limits. Several international funds have already stopped fresh inflows or imposed restrictions on investments. But there are some schemes that are still open for investments. Note that many of these funds stop accepting fresh inflows once they approach their overseas investment limits. So it's always good to keep a few alternative options in mind. And that is exactly why Gift City and international brokers could be some handy options. Gift City essentially allows Indian investors to access global investments and dollar-denominated assets through a regulated framework within India itself. Several AMCs have started launching retail-focused products through the Gift City route, making global diversification more accessible. Just remember, IT, pharma, gold, or international funds can benefit during a weak rupee phase, but chasing any single theme too aggressively can become risky. So, follow a portfolio approach and consider having around 10 to 15% allocation to gold and another 10 to 15% to US equities. These can act as a reasonable hedge during such periods. Obviously, these allocations may not completely eliminate all the risks of a weakening rupee, but they can help reduce and neutralize the overall impact to a large extent. The core of your portfolio should still remain diversified across Indian equity funds, because despite short-term currency volatility, India's long-term growth story remains intact. The focus should be on building a more balanced portfolio, one that combines Indian growth opportunities with global diversification, disciplined SIP investing, and sensible hedges like gold. So, what's your strategy during a falling rupee environment? Let us know in the comments. And don't forget to subscribe to the channel for more insights on mutual funds and investing.